Let's talk about two of the most overlooked real issues that people just fail to pay attention to when they're sitting down at their kitchen table putting together their yellow pad financial plan, and that's taxes and inflation. Let's address inflation first. While many retirees will try their hardest to argue this point, the facts are clear. Inflation is higher for retirees than it is for the working population. And I hear retirees tell me all the time, or pre-retirees, that they expect to spend significantly less money when they retire. And why might they think that? Well, maybe they're not going out to dinner as much. Maybe they're not spending as much on entertainment. Maybe they're not buying cars as often. However, there are expenses. In the places where their money goes just shifts as they enter their retired years. While retirees experience less inflation on groceries and discretionary items like clothing and entertainment, they experience significantly higher inflation on those necessary items like healthcare and housing. And if we actually look at this, we can see that when we look at healthcare and housing, the inflation rate for retirees on healthcare is 11.3% versus 5.6% for people that are still working. That's huge. And even when we look at housing, the housing inflation rate for retirees is 44.5% versus 39% for those people who are still working. So yellow pad financial plans don't work because they're ignoring inflation, and as we're going to be talking about, they also ignore taxes.
Before we move on, let's touch base on this difference.
Yeah, I think that's an important point to really explore. So I think the most important difference between those people who are working versus those people who are retired is the fact that the working people hopefully are getting wage increases at work. Right? Hopefully their salary is going up to combat inflation. What happens with someone who's retired?
There's no income except for their portfolio.
Right. And Social Security is, barely creeping up? And who knows if it's going to be there? Right. So they're really relying on their investment portfolio to not only provide them with the income that they need to live off of, but beyond that, it has to help them to keep up with inflation as well. I think the second biggest issue that's worth mentioning is the fact that when you look at the budget of someone who's working versus someone who's retired, the money is going to different areas, right? And for retirees, they're spending much more of their monthly and annual budget on healthcare and housing, which happen to be incredibly expensive categories.
There's some of the highest inflation components in retirement right now.
Without a doubt. And if we look at this, we can see that the working people are spending 10% of their budget on healthcare versus 14% for retirees. And then when we look at the housing category, we can see that working people are spending 28% of their budget on housing versus 30% for retirees. So it's really those two key categories which cause overall inflation for retirees to be that much higher. What does inflation really mean? It means that your money isn't going to go as far in the future. Loaves of bread become more expensive. The gas that you put in your car becomes more expensive. Long-term care becomes more expensive. College education becomes more expensive. So everything that we consume becomes more expensive over time. So let's look at the impact of inflation. Here we can see the future purchasing power of today's dollar. If we have $1 today, 30 years from today, we're still going to have $1, but it's only going to feel like we have 41 cents. What does that mean if you're retired? Well, if you have a pension, if you're lucky enough, if you're one of the select few who still have a pension, and your pension is $1,000 a month, you will still, in 30 years, be receiving that $1,000 a month, but it's only going to feel like you're getting $410 a month because you have eroded your purchasing power. This next image proves that the future price of goods and services goes up. So if something costs $1 today, in 10 years, that same piece of pizza, that same loaf of bread, whatever it might be, is now $1.35. 20 years from today, it's $1.82, and 30 years from today, it's $2.46. There's only one thing in the world where I have seen that has not experienced inflation like this, and that happens to be those fundraiser candy bars, right? They're still $1. However, the way they've actually gotten you with the inflation is the candy bar continues to get smaller and smaller over time. So they're still $1. They haven't experienced price inflation, but what you've seen happen is that the candy bars are definitely smaller.
So let's shift our focus to taxes. Not many people understand the difference between effective tax rate and marginal tax rate.
That's a good point. I mean, they're difficult concepts to understand, but it's very common that if we have a prospective client walk in to meet with us and we take a look at their income and we say, okay, you have $100,000 of income, you're in the 25% marginal tax bracket. What are they normally going to say to us in return?
Whoa, 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 whoa. I've heard this before. I didn't pay $25,000 in tax, Mark.
Right, exactly. They probably paid closer to maybe $14,000 in tax. So their effective tax rate would be 14%. The $14,000 divided by $100,000.
Right, because you have money going in the 10% bracket, you're paying a little bit of money in the 15% bracket, and you're paying a little bit in the 25%. So like you said, it's the average.
Right. So I think it's important for everyone to understand that we do operate under a marginal tax bracket system, where each incremental dollar you earn is going to be taxed at your highest marginal rate. What's also important is I've come across situations, Tony, where we might be talking about implementing some sort of a tax strategy, or we might be talking about somebody receiving a year-end bonus versus postponing it to maybe January. And for some reason, they're always concerned about getting bumped into a higher tax bracket. Is that even possible?
No, because again, you're going to pay taxes on the average. Now, you said something very key. It's the incremental dollars. So let's say you got a $10,000 bonus, and you're making that $100,000 and you're in the 25% tax bracket. How much tax are you paying? Like you thought you're getting a $10,000 bonus, you open up your check, what's there?
Yeah, you're not paying 14%, you're paying the 25%.
Exactly.
Right? However, I think the important thing to note here is that just because you climb up into that 25% bracket, it is not retroactive to the first dollar that you've earned. It's not retroactive at all. Right? So you have a 0% bracket, you've got a 10% bracket, a 15% bracket, and then 25%. So it is important to note that there's really no such thing as getting bumped into a higher tax bracket, because it does not then enforce that highest marginal rate all the way back to the first dollar that you've earned.
Exactly. So, going back to my example, you get that $10,000 bonus and you get a $7,500 check, the government's just holding on to that money for you.
Yeah.
They'll give it back to you.
Right. And right now, marginal tax rates, the highest marginal tax rate is 39.6%, plus 3.8% for the Medicare surtax if it's off investment income. So, you're really looking at about a 44% marginal tax rate, which is still below historical averages. But I would suspect that at some point in the future, taxes are going to have to go up to counteract this national debt that we continue to accrue. So, I think whenever we're talking about tax planning strategies, it's important that we look at tax planning strategies that are going to reduce the amount of tax that you pay in the future. And that's sometimes the issue that you might have in just getting your taxes done by your local CPA. They're always focused on saving you as much money in tax this year. Even if it costs you 5 times as much over the next 10 years, they want to save as much as they can for you this year. That's why they almost always recommend traditional IRAs, right? The Roth IRA, on the other hand, you get no tax deduction, but it's going to grow tax-free forever and ever. So I'm not saying that Roth IRAs trump traditional IRAs. I'm not saying they're better by any means, but it is important to make sure that you're considering not just current year's taxation when you make any tax strategy move whatsoever, but you're also really looking at how that move is going to affect you over the next 5, 10, 20 years as well.
Right. Understanding taxes and your asset location. Is your money tax-free? Is it tax-deferred? Is it cash? You know, systematically taking the money out for distributions in retirement is key. You have no idea how much value that adds to the longevity of your portfolio.
Yeah, and I think that you just brought up an important point, because Vanguard did a study, and they've shown that somewhere between 0.5% and 1% a year of value add can be delivered to a client by making sure that you have the most efficient withdrawal order or spending order from your accounts in retirement. It's not necessarily spending all of your cash first and then spending all of your traditional IRA money and then lastly tapping your Roth IRA money. Right. What we can do is, through our financial planning process every single year, if you need $50,000 of additional income above and beyond your Social Security, any pensions you might have in place, we're going to optimize your withdrawal order. So we're going to make sure that we let you know that the best spending strategy for you this year is to take $20,000 from your cash account, $25,000 from your traditional IRA, and the rest of the money from the Roth.
Right. That adds so much value, like you said, and it just can't be, emphasized enough. People, they don't even understand it. That's, it's like you don't know what you don't know.
Exactly. It's significant. And just to kind of wrap this up, again, I want to reiterate the fact that whenever you're making a tax planning decision, make sure you're not only looking at how it affects you today, but you're looking at how that's going to affect you over the long run.
Right. And working with an advisor that understands this stuff and is paying attention to it. Key.
Good point. How well are you managing your wealth? Are you taking advantage of all opportunities that are available to you? Just as it makes sense to have regular physical checkups to make sure you're maintaining optimal health, it also makes sense to do a regular checkup on your financial situation. Our Wealthalize tool will provide you with that diagnostic. Simply complete our online questionnaire in under 15 minutes. Our proprietary software will analyze your investment strategy, tax situation, asset protection, estate planning, charitable giving, and your professional relationships. You'll immediately receive a score ranging from 0 to 100, which assesses your situation. Additionally, you'll receive a SWOT analysis, which identifies your strengths, weaknesses, opportunities, and threats that could impact your wealth management. Visit today, www.wealthalize.com.